The topic for today is tax and retirement strategies for gamblers. Now, I am the first to recognize that this is probably not the most engaging topic that I've ever done, and it's probably a different audience tuning in today. That's fine, because I believe there is kind of a lack of solid information when it comes to tax and retirement information for gamblers. And a lot of the reason for that is because the IRS is not really that kind when it comes to gambling income. So let's get started. We can talk about it a little bit. But first, I do want to say the following disclaimer. I am not a lawyer. I am not a CPA. I am not an enrolled agent. I am not even a certified financial advisor. So take that for what it's worth. I am a guy who gambles for a living, and I have paid taxes on my gambling for many years now. And being an advantage player myself, I've always looked for a way to get an advantage when it comes to all things I do, including my taxes. So I always look for a legal advantage. And so I've researched this quite a bit in terms of my own life and my own filings. And that's kind of carried over to giving some advice to other people. And I've given this presentation before, and it was received fairly well. So hopefully you can get something out of it as well. Okay, so let's first talk about the subject of taxes when it comes to gambling. And let me put this out here right from the start, is all income is taxable. So all gambling winnings are taxable. The IRS has kind of a weak guidance when it comes to gambling income and how it's taxed, and that leads to a lot of confusion. For instance, if you take the letter of the law of what the IRS says, they want you to declare all your winnings in one part of your tax filing and all of your losses up to the point of your winnings in another part of your tax filing. And we're going to get into why this is really a bad idea for anyone to follow the letter of the law shortly. But the bottom line is a lot of gamblers don't pay taxes. And that's just because they feel like they shouldn't be entitled to pay taxes because they don't win long term. And that's true. But if you are one of the gamblers who wins long term, you need to recognize that paying taxes is not a bad thing. In fact, hoarding your cash is a bad thing because our current situation not included, but hoarding your cash basically creates a situation where the world is moving without your money in it, and your money is not working for you. When you have cash, that cash is going to be worth a $100 bill is going to be worth $100, whether it sits under your mattress or in a safe at home. But if you're just hoarding that cash, that $100 doesn't grow. Whereas if you put it into an investment or you put it to work for you in some way, you can gain interest on that as an investment, and that money begins to work for you, and you overcome the effect of inflation against those dollars. So the key takeaway that I would hope you get today is that you need to put your money to work. And if paying your taxes is the way that you can put your money to work, well, then it's a necessary evil. I do want to make a book recommendation right here at the start. Tax Help for Gamblers, the 4th edition, is an incredible resource. There were previous editions, and the reason that I recommend the 4th edition is Russell Fox is a contributor this time around. And Russell is one of the preeminent names and minds when it comes to gambling income and how income taxes affect gamblers. He's really a great addition to this book. Marissa Chen is also a great mind in this as well. She's a CPA, Russell is an EA, and then you have Jean Scott, who's a longtime author, and she kind of ties it all together. She's the queen of comps. I don't know if you've ever seen her books in the past, but she's a nice woman, and she kind of ties it all together. But it's a great resource. So if you have any questions regarding how this all impacts you and your gambling income, check that book out. So we're going to briefly start with talking about recreational gambling and taxes. And we're going to do this only briefly because this isn't a great situation for anyone to be in. So the IRS is basically your silent partner. They are there to take a piece of your wins, and they are there to, if you end up having a net loss on a year, they say, you handle that. It's it's not a good situation for you. They're basically free rolling you. But here's the bigger problem is if you declare your taxes as a recreational gambler, declare your winnings as a recreational gambler on your taxes, you're inflating your AGI. Your AGI is your adjusted gross income. And that comes into play. For instance, the stimulus check that we're all quite familiar with, that phased out, I believe, starting around $72,000 of AGI, up to $100,000. And so certain people weren't able to get the stimulus check because they had too high of an AGI. And what happens is you declare your winnings on your 1040 under other income, and then they allow you to deduct those losses up to the point of winnings on your Schedule A, assuming that you itemize deductions. But here's the problem. A lot of people now with a higher standard deduction with the new tax code, they don't itemize their deductions. So basically they just have their winnings out there and none of their losses deducting against it. As you can see, that's not a great situation to be in. Now, the IRS does allow you to session your gambling activity. And here's the thing, they don't give you a clear guidance on what makes up a session. So if you were to take that completely liberally, you could say, oh, my session is the entire year. So I'm only going to report on the other income section of the 1040, my net winnings for the year, because the whole year was a big long session for me. I don't know if that's the best case to do. That's really taking it a bit far in terms of their allowing you to session your winnings out. But that's an angle that some people have tried and will continue to try. And we'll get into a little bit later about audit rates and things like that and why possibly doing it that way might not be the worst idea, not as big a red flag as you might think. But a key point, if you're a recreational gambler, and when I say recreational gamble, I mean you don't intend to win over the course of the year. You really want to avoid W-2G forms. And a W-2G form is when you hit what's called a hand pay jackpot, and they come around, and if you're on a machine, that's anything over $1,200 triggers a hand pay. If you're on a table game, it's 300 times your wager and over a threshold of $5,000. And if you're a sports bettor, which most of the people are that are watching this webcast, it's also 300 times your bet and exceeding $5,000. So for most people, they're not going to hit a W-2G form if they're just strictly a sports bettor. However, you do need to take that into consideration. And also, we've seen in New Jersey that some of these online sports books mistakenly issued W-2G forms for people that had less than a $5,000 win and less than 300 times their wager. And I actually helped a couple people deal with this from one of the online sports books in New Jersey. And the sports book finally came back and said, oh, you're right, that was a mistake. So, you know, if you're filing your taxes with just your 1040 and your standard deduction, throwing a W-2G into the mix is not going to be pretty. You're going to end up paying extra taxes on top of that because you're not going to be able to itemize out your losses up to the point of winnings. So really, you know, in that situation, you want to totally avoid it. But that should be a key point that people take away. If you're just a recreational gambler, the W-2G form, the hand pay jackpot, is not something you really want to pursue a whole lot because that'll get you into trouble. So we'll shift gear here into professional gamblers and their taxes. And this is sort of the bulk of my talk here today. When you're a professional gambler, you have a business structure according to the IRS. You have your own business. Now, you might think to yourself, I could never be a professional gambler. I have a day job, and so there's no way that I could be termed a professional gambler. Well, technically, the IRS declares that you are a professional if you conduct yourself professionally. So you can have more than one job. It's purely viable as long as you conduct yourself professionally and you have a plan. So if you're not a long-term winner, if you're not someone who's going to win year after year, then there's really no way you can kind of convince the IRS that you're a professional gambler. However, if you are a winning player, if you have a plan, if you make a plan each year and you follow that plan and that plan, the expected value of that plan is positive, then you can declare yourself as a professional gambler. You can get an EIN, which is an employer identification number, and that's sort of like a social security number, but for a business. And you can use that to file taxes as either a Schedule C sole proprietor business or as an S-Corp. And we're going to go over both of those and see what the advantages are for each of them. So if you file as a Schedule C, this is the most common way that self-employed people file. You've probably heard a lot about self-employed income during this pandemic because the government decided that self-employed people are eligible for unemployment during this time, even though as filing a Schedule C, you do not pay into unemployment insurance. It's widely used by many people in terms of everything from if you're an Uber driver to if you write science fiction novels on the side, if you give talks at universities about things, you can consider yourself to be self-employed, a gig worker, so to speak. And Schedule C is actually made for self-employment. It's all about just having a sole proprietor business that's just you. You can consider your spouse to be an employee as well, but it's just you as the sole proprietor of the business. And basically it's pass-through income. So income that your business generates passes through to your personal income, and that's how you pay taxes on it at your prevailing personal rate. Now, an S-Corp, on the other hand, is a little bit more complex of a situation. And there are various levels of an S-Corp, but we're going to speak just generally right now. And that is you have a business that also is passed through, but it passes through the profits in terms of dividends that it pays to the shareholders, which is, again, if you're an S-Corp, it's just basically you. And this is a good way to be structured a little bit more. You actually avoid some self-employment taxes if you're filing as an S-Corp. But here's the thing. An S-Corp has an extremely high fiduciary responsibility when it comes to the IRS and to payroll. You pretty much have to have a payroll company handling your business when you file an S-Corp, because you're going to have to issue a paycheck to your employees, which is basically yourself. You're going to have to handle the quarterly dividends. You're going to have to make sure that the proper taxes are being taken out of each. It's a lot more work to run an S-Corp, but also it also benefits you to have the lowest audit risk. And we're going to talk a little bit about audit risk next. But basically, if you're running an S-Corp, the IRS pretty much assumes you've got your stuff together and you are functioning properly. And so they take it a little bit easier. They don't look for nitpicky things to audit you about when you have an S-Corp. But at the same time, you can expect they're probably going to send you half a dozen letters throughout the year saying, is this payroll deduction correct? Can you back this up with facts and figures? So don't think that you're operating free of the scrutiny of the IRS when you're doing an S-Corp. So we're going to talk a little bit here about audit risk. Now, why am I bringing up audit risk? I'm telling you to pay all your taxes. Why do I bring this up? Am I talking about what you can get away with? No, I'm not talking about that. What I'm talking about is audits are not fun, and they're going to take time and they're going to take effort, and you may need to hire someone like an enrolled agent or a tax attorney to represent you if you wind up in an audit situation. You want to avoid audit situations as much as you can. They're not going to be fun. I've never been through an audit myself. I've talked to plenty of people that have. None of them recommend it. Now, I have answered letters of inquiry from the IRS in the past, and fortunately, they've accepted my explanation on things, and that's been the end of it. But let's briefly go over these numbers just so you're familiar with what's going on here. If you declare no business income, in other words, if you just say, the IRS doesn't need to know about my gambling income. If you declare less than $25,000 of total personal income, you got about a 2% chance of being audited. If you're in that broad range there of $25,000 to $200,000 that most Americans fall into, very low chance of audit risk at that point. And then, of course, if you have over $200,000 of income, your audit risk jumps back up over 2%. Now, compare that to Schedule C, where the line of demarcation is right around $100,000. If you declare less than $100,000 of Schedule C income, this is business income, you got about a 2% chance of audit. Over $100,000, 2.4%. I didn't add it in here, but as you go up towards $1 million, your audit risk becomes up near 7 to 10%. So hopefully none of you are going to be in that situation. And I guess if you have $1 million of annual income related to gambling business, then hiring a tax attorney is no big deal for you. But you look over at the third column here in the S-Corp, and you see that there's just a blanket 0.4% chance of audit risk when you're filing as an S-Corp. And that goes to the fact that the IRS realizes that you probably got your stuff together when it comes to forming and running an S-Corp related to payroll taxes. So that's the basics of the business structures. Let's talk about lowering your tax burden. So the thing that running a gambling business affords you is that your deductions are taken what's called above line. In other words, whereas before we had to deduct any losses on Schedule A and itemize those deductions, in running a Schedule C or an S-Corp, all of your losses come above line, meaning before you ever get to your net business income, you can deduct out your losses, you can deduct out your expenses, and some other things that we're going to talk about here. So the first thing we need to talk about, though, is expenses. So if you're a recreational gambler, you cannot expense your trips to Vegas as a business expense. If you're a professional gambler, you can deduct your business trips to Vegas or any other casino destination that you're going to ply your trade at. And this is very useful because travel expenses really eat into the life of a professional gambler because they can't just ply their trade at the same casino every day. They need to move around. They need to, definitely go to different locations so they're not so recognized and grab their little pound of flesh everywhere that they can go. If you are running up expenses, you do need to track your expenses. And so I would recommend you document everything. Keep a logbook of everything you do when it comes to your career. I keep a log of every bet that I make, of every hour that I spend doing tasks that are expenses for my business. You need to keep track of receipts if they're over $75. And a lot of this information in terms of tracking your expenses is easily researchable. I don't want to spend too much time on this because there's books that have been written. There is websites galore about how to track your expenses when it comes to being a self-employed person. Let's talk about some of the things beyond expenses, some of the things they don't mention in a lot of these sources. Section 179 deductions. So a Section 179 deduction is basically you take all of the depreciation for an asset that you purchase during that tax year, and you take all of your depreciation at once rather than amortize it over a 5 or a 10-year schedule. This means that if you find yourself with a significant profit in a year, in let's say December, you can say, well, I guess I could use a new computer system to do my business, or I guess I could use some new, if you had a non-gambling business, I guess you'd use some new tools. I guess I could use this or that, a new cell phone for tracking my wagers. You can basically purchase those items and then take a full Section 179 deduction for the full purchase price of that, and that comes off of your income for that year. And this is something we're going to talk about a little bit further when we decide what's better, a Section 179 deduction or amortizing that over the course of a couple of years. Another thing that to do with beyond expenses is personal branding. So right now I'm talking to you on YouTube. This is sort of a personal brand for me. So the expenses that I have on this, where I have some lighting and I have some video editing software and I have a camera, those are all expenses that were tax deductible for me because I'm building my personal brand when it comes related to my professional gambler business. It's pretty straightforward. Now, also any income I make off of YouTube then of course goes into that brand as well. As of right now, there is no income, but maybe someday there will be. I don't know. But for right now, this is a personal brand, and you can consider that. Now, I've seen people that they buy a new car and they say, well, if I get seen in this car, people are going to think I'm a better fill in the blank, real estate agent or attorney or something like that. And so they say, this car is part of my personal brand. I don't know, that kind of might stretch it a little bit, but those are the sort of things that a lot of people do when it comes to things like this. And then the next thing is HSA and 529B. So HSA is health savings account. And if you are single, you can contribute $3,500 a year to a health savings account. And that is then tax-free money. First of all, it's tax-free on the deduction, on the contribution. And then that is money that you can withdraw tax-free if you use it for any kind of medical expense. And medical expense is wide-ranging. It could be contact lens supplies. It could be things you buy at a drugstore, or it could be elective surgeries, or doctor's appointments, co-pays, and things like that. But this is, if you're single, that's $3,500 less of income that you have to declare. And if you're married, it's double that. It's $7,000. 529B is the same sort of thing, but this time it is for education expenses. You can contribute to a 529B plan. That contribution is tax deductible, and then you can withdraw from that plan at any time and use it for educational expenses. Now that could be for you, that could be for your child, that could be for your grandchild. And educational expenses doesn't need to be exactly a school of higher learning, like college education. It could be for personal education as well, as long as it is an accredited source of your education. And then also another key way to lower your tax burden is the QBI deduction. So this was something that was put in play in the last tax code revision that went into effect for tax year 2018. And this is qualified business income deduction. And what this is pretty much a blanket 20%. If you run a business, it's a blanket 20% deduction that you can take off of your net business income. Now remember, net business income is after all of your other deductions in terms of expenses, healthcare, advertising cost, all these other things that we were just listing. Where the number that you have left over is your net business income, and you can take 20% of that. Now, if you're a professional gambler, you're in a service industry, and there are limits. And I believe the limit is currently about $145,000 if you're single, double that if you're married and filing jointly. And basically what this is a 20% deduction from your income. That's pretty big. That's for most people, that's tens of thousands of dollars of income deduction that they can take each year. It's a great thing to have. I'm not sure how long it's going to last. It seems to be one of these things that's always too good to be true. So, but we'll see. The way small businesses have gone lately, this might stick around for a while. Another key way to lower your tax burden is marriage. So this is, it is what it sounds like. If you're married and filing jointly, basically all of the income limits and various limits, they double. And also if your spouse works and works for outside of your company, maybe he or she can provide your healthcare benefits, which lowers your cost burden. And if your spouse works for you, then that also doubles your retirement funding contribution levels. And we're going to talk about retirement funding in detail next. But basically, if you have a wife and she books some travel for you, as you're a professional gambler, you travel a lot, your wife handles booking some flights for you. She is materially part of your business now, and therefore you can contribute to a solo 401k or a SEP-IRA in her name, and basically increase your contribution limits when it comes to retirement funding. It's something to try. So let's talk about retirement funding. So this is a key point. We're going to spend a few slides on this. Here, I think, is the best advantage when it comes to becoming a professional gambler or becoming self-employed. The IRS gives you crazy generous limits on your IRA contributions. Now, if you're working a regular job, you probably have a 401k plan through your employer, and you have limits as to how much you can contribute to that. And usually your employer matches part of your contribution. But if you are self-employed, you take both the employee contribution and the employer contribution. So the employee contribution is fixed, and I think it's about $17,000 a year that an employee can contribute to a IRA, retirement account. And if you're the employer, though, it is basically variable up to a percentage of your income. And we're going to get into that here in the next section of professional gambling and retirement. But basically, what it's going to be doing is you can contribute up to 25% of your income as a retirement contribution, which means if you make $200,000 in a year, you can contribute $50,000 into your solo 401k, and your income has now dropped down to $150,000. And if you take into account that QBI that I mentioned, that deducts it by another 20%. And if you have various other expenses, anyway, if you're making $200,000 a year, you might get your taxable income down to well under $100,000 via all of the benefits that they give to a self-employed person. So let's talk about retirement a little bit here. When it comes to retirement accounts, there's basically two main types. There's a traditional IRA and there's a Roth IRA. Now, the traditional IRA is tax deductible as your contributions go into it. These are standard investments. These are easy to set up. They usually have low fees. You can put everything into an index fund and pay very low fees. It's sort of the easy path of retirement. A Roth IRA, on the other hand, is something that came up a few years back and still exists. And basically, you contribute, but you pay the tax up front, and your money goes into the account. And then when you withdraw, there is no tax on your withdrawals. So basically, you're paying the tax up front, and you're hoping that 30 years down the line, when this money has accrued a bunch of interest and has swelled up to a nice big nest egg, you can take that money out tax-free, and you'll do whatever you want with it. And having paid the tax up front, you save quite a bit in 30 years' time. Now, when it comes to being a self-employed person, you have a couple different options in terms of your retirement account. You can do a SEP-IRA, which is very easy to set up, and it has basically an 18.6% contribution limit. So, like I said, if you're making $200,000 a year, roughly $36,000 would be your contribution limit to a SEP-IRA. But then there's the solo IRA, and the solo IRA, also relatively easy to set up, has a 25% contribution limit. So there's that instance where I said, if you're making $200,000 a year, now $50,000 is your limit as to what you can put into it. And the difference in terms of setting these up is you can set up a SEP-IRA anytime until you file your taxes for a tax year. So in other words, right now we've all been extended out to July. You could set up a SEP-IRA right now for 2019. Solo 401k, you need to set that up within the tax year. So if you were to set that up now, it would take effect for 2020 tax year. But let's talk about some of the things beyond retirement accounts. So there's also what's called an SD-IRA, which is a self-directed IRA. So like I said, you can put your money into an IRA and you can have it be in an index fund and be pretty boring and all that stuff. But let's suppose you, as a professional gambler, like to gamble a little bit more with your money. You can do an SD-IRA, which basically allows you to self-direct what you want the IRA's money to go into. For instance, if you wanted to invest in real estate, you could do that. You could basically buy a rental property with your retirement funds and have that income go back into the IRA that you generate from the rental property. You could invest in small business through an SD-IRA. You could invest in cryptocurrency through an SD-IRA. Now, here's the thing. These companies are not Fidelity and Vanguard. These companies are much smaller. They have higher fees. They have different catches here and there. And I think if you were to talk to a CFA, a financial analyst, he would shy away from encouraging you to go down the SD-IRA route. But it's possible. It's out there. I wanted to make sure you knew about it. And then the last thing you could do with an SD-IRA, and this is, again, a liberal interpretation of it all, you could invest in yourself. You could basically be investing in your own business through your retirement account and funding your bankroll. I'm going to leave that as an exercise to the listener to figure out how exactly to go about that. I don't think it would pass the sniff test when it came to legality, but I'm going to mention it anyway. And as always, you should look into anything that I'm saying here. Talk to your CFA, CPA, tax attorney, enrolled agent, whomever you need to run this all past. So now here's the last thing I'm going to mention in terms of retirement strategy, and that's the Roth IRA rollover. So there is sort of a backdoor into a Roth IRA. You can convert a traditional IRA into a Roth IRA at any time. You just have to pay the taxes on the cost basis of the traditional IRA that you're converting over. And you can do this to circumvent the Roth limits. I think I forgot to mention, but a Roth IRA has a limit of $5,500 per year that you can put into it. However, you could have a $50,000 traditional IRA and roll that over into a Roth. You have to pay taxes on your cost basis of that traditional IRA, but now you have that money. It's accruing at tax-free status, and you're going to be able to withdraw it tax-free 20, 30 years from now. It's a pretty good deal to do, and it's especially a good deal in a bad year. And let's talk a little bit about good year, bad year. So if you have a good year, you want to max out your retirement accounts. That'll lower your adjusted gross income. You want to take a Section 179 deduction as much as you can. You want to maybe increase your donations. If you're a professional gambler, you're probably itemizing your deductions, so therefore charitable donations are still a thing, and you can make some donations to companies and lower your AGI. And you also want to tax harvest your losers. So in other words, if you have other investments and they, at the end of the year, you're going to have a pretty fat income, go ahead and sell some of your losing stock to then create some losses in your investment portfolio. That way, it'll offset some of your wins and also then allow you to kind of lower your adjusted gross income. Now, conversely, if you have a bad year, you want to max out your Roth contributions. Maybe you even want to roll over a traditional IRA into a Roth because you know you're going to take a little bit more of a tax hit, but since you had a bad year in the first place, you have a little bit extra money that you can kind of devote to this, and you're going to make money back in the long run. The other thing is you don't want to do a Section 179 when you've had a bad year. You want to spread that depreciation out over time. You're not getting as much benefit from this year tax savings on a purchase of an asset as you would if you spread it out over 5 or 10 years. And then, of course, you also want to tax harvest your winners when you have a bad year because you can afford to have a little bit more income in there and not bump yourself up into another tax bracket beyond that. So I know I kind of sped through this a lot pretty fast, but I wanted to be cognizant of our time and cognizant of the amount of focus that a lot of people have when it comes to these tax and retirement issues. We're going to run through a couple scenarios here, and I think this will drive home everything I've said, and hopefully you'll see kind of how this all plays together. So scenario number one, you're a single person. You have $50,000 of non-gaming income. This might be a day job. This might be interest and dividend income, and you have $150,000 of income, gaming income. So you had a pretty good year. If you were to just basically just pay your taxes with a standard deduction, basically your tax liability for this is $38,000 roughly. That's kind of a tough bullet to bite into, right? Because $38,000 is a good chunk of money. What can we do to get that down a little bit lower? Well, here's a couple things. If you were running a gaming business, you probably had expenses. You probably had quite a bit of expenses if you were able to rack up $150,000 in profit. So let's just theorize you had $20,000 in business expenses. Now, they can be anything from travel to subscription costs to meals on the road to, it goes on and on and on. And like I said, there's plenty of sources out there where you can kind of get creative with a lot of your expenses. Let's go ahead and we'll make this the maximum contribution to our solo 401k, and that is $47,000 that we're going to put into our solo 401k. We're also going to max out our HSA contribution at $3,500, and we're going to make some purchases of some equipment that we're going to depreciate right away, and about $10,000 in Section 179 deductions. And then on top of all of that, we got that QBI deduction, which even after all of those expenses are factored out, you still have 20%, and that equals $13,800 to deduct. So now your total tax liability is $13,500. So you've basically taken about a $25,000 chunk out of the amount that you were going to pay to the IRS. Okay, that feels good, but what about that money that we put into the solo 401k? How's that going to work out? Well, in 25 years' time, that money is going to be worth $409,000 if it all goes to how it's historically gone in the stock market, putting that into a general index fund. $409,000. So you saved $25,000, turned it into $400,000. That's a pretty good deal. That's a big reason why you want to get your money out of just hoarding it in cash and putting it into the system to work for you. But let's say you had a bad year, or maybe a not so good year, an average year, we'll call it. Let's say you're married and you have about $20,000 of non-gaming income. You know, these are dividends and interest and whatnot. And you had $80,000 of gaming income, which for some people is not bad. But if you're working your tail off as a professional gambler, kind of want a little bit more reward than just $80,000, and especially if you're married. Your total tax liability here is only $8,600, which, okay, that's not bad, but I think we can get more out of it. So let's just say you had about $15,000 in business expenses, which would be average for that amount of gaming income and travel involved. And this year we're going to make a non-deductible contribution. So in other words, we're not going to take the tax deduction when it comes to our contribution into the 401k. We're going to make a non-deductible contribution because we're going to then roll that over in the same year into a Roth IRA. It's a backdoor conversion. Pretty much any investment house could help you with that, Fidelity, Vanguard, whomever. We're still going to take the maximum HSA contribution because that's just good business. And we're going to do some tax harvesting. We're going to sell some winners. So we're actually going to inflate our taxable income with some capital gains wins. But we're still going to be able to take that QBI deduction, which offsets about $11,000. Anyway, push comes to shove, we've trimmed down our tax liability by about $5,000. We've set ourselves up very well for the future because we have not only tax-deferred earnings, we have tax-free earnings on that $33,000. And in time, in 25 years, that $33,000 balloons into $284,000 if invested in traditional ways. So as you can see, you know, even in a bad year, you can still find a way to reduce your tax burden as well as save for the future. And, you know, you end up creating a very nice nest egg if you're self-employed due to these generous contribution limits, assuming that you can afford to contribute these large amounts. You know, if you have some college education going on in there as well, it might be a little tougher to hit those numbers. But in this scenario, it's a good way to kind of take everything that you have, prepare for the future, because one day you're going to be tired of gambling all the time. That's kind of how I am. About 5 years ago, I set out and I decided, okay, what do I need to retire? I made a number that I needed to retire by. And I paced it out on how my income was going, and I decided that when I hit 50, I was going to be able to retire as a professional gambler. And this current downturn in the market, as well as the pandemic, it's probably added a year onto the course, but hopefully I'm still on pace to when I hit 50, I'm 45 now, I'll retire from gambling, professional gambling. Here's the thing, I'm not going to be able to walk away from this. You know, it's in my blood. It's what I do. However, it's no longer going to be my primary source of income. I'm going to have investment income. I'm going to have retirement income. I'll have to wait another about 9 years until I can start to take out 401k money, but I'll have other income that I've stashed away, or other savings that I've stashed away to provide income in that gap between when I retire and when I can start withdrawing IRA income. So it's good to have that goal in mind. It's good to think that, you know, I'm just not going to grind forever. I have a goal in mind. So that was a little bit longer winded than some of my other presentations. We're going to move into the Q&A section here. If you're in the Zoom room, you can type a question into the Q&A section. If you're on the YouTube, I will check out the chat there. And if you want to actually speak to me, we can try enable the audio if you raise your hand, and we'll handle it that way. So let me I'm going to go to full screen here, just so I'm not up in there in the corner as much. So we do have a couple questions that are in the Q&A already, and I'll start to address those. Anonymous asks, do players with post-up money on deposit at an offshore sportsbook have to file an FBAR with their taxes? That's a good question. So an FBAR is a foreign bank account registration. I'm not sure if that's what the FBAR stands for, but basically it's a declaration to the IRS that you have money in a foreign bank account. And yes, technically an offshore book that you have a deposit in is an FBAR account that you need to declare to the IRS, as is any cryptocurrency holdings you have. That's technically should be an FBAR filing as well. FBAR filings are not a big deal. It's sort of like filing a CTR when it comes to a cash transaction. It's not like this is an audit flag. However, here's the thing. If you fail to file an FBAR, and if the IRS finds out about a foreign bank account that you're holding and not declaring, the penalty, potential penalty, is 50% asset forfeiture, meaning you can lose up to 50% of that bank account amount, or in this case, your offshore sportsbook deposit. But here's the thing. When you have an offshore sportsbook deposit, money is coming and going out of that. It's tough to kind of decide at what point you're going to file that FBAR. And so that's a little bit more of a technicality that you'll have to kind of work through on your own to figure out, at what point do I file the FBAR? Do I take it on December 31st, or another point in time? Do I empty all my money out and then file the FBAR with what's left? That's up for you to decide. Steve asked, what was the name of that book again? So the book is Tax Help for Gamblers. If you're on YouTube, or you go to the YouTube video, it's in the description, a link to the book. It's an Amazon link. It is an affiliate link. I'll go ahead and declare this. So I get like $1.35 if you buy the book through that link on Amazon. I'm not retiring on that $1.35, but just to be transparent, that the links that I put in the video that go to Amazon are affiliate links where I get a small kickback. And by the way, you want the fourth version of that, the fourth edition. That I think has a value add over the other editions. Okay, Ryan asks, are you considered a recreational bettor if you make profit each year, but it is not a substantial amount, say $50,000 or less, for example? Well, Ryan, you're a recreational bettor if you want to be a recreational bettor. You're a professional bettor if you do that with a plan, if you basically conduct yourself professionally, if you have a business plan. So I don't know much about how you're playing that you would have a win year after year, but just because you have a win doesn't mean you automatically become professional. It doesn't mean that you can't be recreational. There's plenty of people that win at gambling over the course of a year, and they're still recreational. You're just restricted by some of those tax hindrances that I went over there in terms of recreational gambling. Gavin asked, will this deck be available for download? Well, you'll be able to watch the YouTube video. I'm not putting up the PowerPoint presentations into any kind of downloadable format, just because I have my notes that I kind of write in the margins that I can see for when I'm doing the presentation. So I'd have to go back and clean them up. So I'm not really making the PowerPoint presentations available, but this video will be on YouTube, and you can go in there and, if you want to take screenshots or take notes, but it will be available in perpetuity for you to check out there. Okay, I'm going to hop over here to YouTube and see what we got. Kevin asked, are you a sports bettor or a table poker machine gamer? All of that. I'm a professional gambler, and sports betting makes up part of what I do. In recent years, it's been my primary source of what I do as a professional gambler, but it's not everything that I do. I have a good idea for a video sometime. I'm going to go through and say, basically the video idea will be how to make $100,000 at gambling. And I'll let you know right now that the way to do that is to find 8 different ways to make $12,500 at gambling, because there's really very little chance you can take one thing when it comes to being a professional gambler and extrapolate that out into being a $100,000 idea in 1 year. Those things are very rare. However, what you can do is come up with little ways to do this and that. So maybe I can beat props at sports, and maybe I can hustle some machines in a casino, and maybe I can win on some promos at video poker, and down the line maybe I can count some cards at blackjack. So there are many little different ways you can be a professional gambler and make money. You just don't have to follow one solid set narrow path. Kevin also asked, top 5 tips, most important variables for handicapping games. Well, that's probably a little bit more than we can get into on this webcast, Kevin. That seems like a good idea for one of my regular webcasts where I go have 5 ideas at 5 p.m. on Fridays. So thanks for that tip. Maybe that's what I'll do. 5 most important variables for handicapping games. Not a bad idea. Victor asks, how long do you think one can stay in Las Vegas and still deduct travel and lodging as a professional gambler? In other words, how long until Las Vegas would become one's tax home? Good question. So there is some guidance on this from the IRS. And basically, it more has to do with your home office declaration. So if you travel to a place of work, you cannot deduct that if you travel to a primary place of business, you cannot deduct that as a traveling expense. So for instance, let's say I worked out of an office 5 miles from my home. I can't deduct that 5 miles in mileage expenses each day. It's my primary place of business. However, if you have a home office, then any travel you do outside of the home office becomes a travel for business that you can deduct. And I'm very dark in this video, aren't I? 1 second, let me just brighten up my light. Okay, sorry. So in other words, if you were to have a home office and you go to Vegas, every weekend, that's still fine. That's still your place of business that you're going to, and you can deduct that travel expense. In terms of like if you are a nomadic gambler and you're just going everywhere to gamble wherever you can, those travel expenses are warranted because you're basically going and your place of business is always changing. Do you have to, Gail asked this, do you have to register as a business with the state you live in? Are you setting up a business with your state of residence like Nevada? If you are a sole proprietor, you do not need to be a registered as a business because your federal tax ID carries over. And technically, if you're a Schedule C filer, the pass-through income is basically all you need anyway, and you technically don't even need an EIN if you are a Schedule C filer. Now, if you run an S-Corp, you have to incorporate yourself as a corporation, and you don't have to do that in your home state. You can if you want, but different states are better for incorporation. So for instance, Delaware, Florida, Nevada all have 0% corporate taxes. So a lot of people incorporate themselves in those states. And that's why you always see like banks listed as a Delaware corporation. That's exactly why they do that. So you don't need to file yourself as a business within your home state. Of course, now the state where you reside is where you're going to pay your taxes. So if you spend more than half of the year residing in your state, that's the state to which you pay taxes. And furthermore, if you earn money outside of your state, you need to pay taxes in the state that you earn as well. So keep that in mind. That's you'll read that in that book, Tax Help for Gamblers, because your winnings in other states sometimes have a cross agreement with the state that you live in. Other times they don't. You might end up having to file state income tax returns for multiple states when you're a professional gambler and operating around the country. Trevor asks, which sport do you think will be affected most by crowd minimizations as we live in a post-corona world? That's a good question. A little bit more sports betting related. I would say, he said, I say basketball. I don't disagree with that. Basketball home field advantage is largely due to crowd. I think football is viable because remember in football, you have false starts and that's usually due to crowd noise. So that could definitely play a factor into it. I think baseball is probably the least affected, in my opinion. But it's tough to say. That's a good kind of theoretical question to ponder. Once we know when we're getting back on track here with all of this, we can go over things like that and try to find where the edges might be or what we need to factor into our handicapping as a result of all of this. Let's see, what else do we have here in the Q&A? Someone had asked in the Q&A, if you have winnings from multiple states, do you have to file a return for each individual state? Yes, and I kind of answered that with that other question. Somebody asked, what amount does your gaming income have to be before one considers going pro? I've made about $10,000 per year for the past 3 years. It's not much, but I want to scale up and devote more time to sports betting / gambling in the future. That's a good point. There is no benchmark. Like I said, in order to be professional, you have to act professionally. That's basically the only threshold that the IRS states out there. So even if you're a small-time player, but you do it very disciplined, you make a plan for yourself, you record everything, you keep a contemporaneous log of everything you do. Those are key points into being a professional gambler, no matter if you make $100,000 or $100 at it in the course of a year. So feel free to explore this if you find yourself being that kind of gambler, that kind of taking it serious enough. Here's a little bit of a caution, though, is one of the tests that the IRS would do to find if you are running a viable business is to make sure that you've profited in at least 3 of the past 5 years. So if you're doing this and it's like, I might win or I might lose, keep in mind that if you fail that 3 out of 5 test, you could have the IRS say, no, you're not a professional gambler. You're not running a valid business here. So that's just something to keep in mind. I had another point with that. Anyway, the point being is you can't go back and forth, though. You can't complete a year and say, well, I was a professional gambler last year because I made some big amount of money, and then next year be like, well, I guess I wasn't a professional this year because I lost money. It's not gonna. No, you have to be consistent with it. You can't just go in and out of business based on your income. That's not how it works. So just keep that in mind as well. Okay, a few more questions here. Oh, do you think one could trust a chain like H&R Block to do their gambling taxes? That's a good point. I should have put this in the presentation. Here's the problem when it comes to gambling and taxes and gambling. And this is why I wanted to do this video, is because nobody ever knows their ass from a hole in the wall when it comes to gambling and taxes if you go to one of the big chains to handle your taxes. In fact, your local CPA that might handle your family taxes all well and good every year, they probably don't know either. Now, they could do the research, but often when they see gambling and taxes, self-employed income, they immediately think you're trying to pull one over and they're going to dissuade you from it. So that's a key point. I do my own taxes. I use TurboTax Home and Business. It works very well for me. Basically, the business part of it handles my Schedule C income. I have some rental properties that handles my Schedule E rental income. It allows me to issue a 1099 if I have partnerships with other gamblers, and I issue them a 1099 if need be. It can handle all of that. If you're not comfortable doing your own, you're going to need to find a good tax guy. Now, one of the reasons I referred to that book, Tax Help for Gamblers, and I wanted the 4th edition, is because Russell Fox is contributing on that. And Russell Fox is one of the best tax guys for gamblers. And Russell can do your taxes, but keep in mind, Russell is very straight-laced. He's very detailed. He's the one that, when I was talking about those FBAR declarations, he's the one that I first heard about talking about FBAR declarations for cryptocurrency. So just keep that in mind when it comes to doing your taxes. H&R Block's probably not going to cut it. I would recommend you learn and do it yourself. But if not, you need to find a CPA that will handle gambling income. And you're more likely to find those CPAs around Las Vegas or Atlantic City, a place like that. Okay, Brian's got a question here, and I think this is one of our last questions. So if you have any other questions, get them in now. Brian says, if I have a planned approach for my gambling, i.e. how much I bet, how often I bet, etc., but not the expenses side of things, if I plan on becoming a pro, should I track those expenses before I make that jump? You don't need to, but it might be useful for you, Brian, in figuring out exactly how that would play into your total income and deductions, is to track your expenses now before you're able to deduct them. It's probably more work than you need to do, to be honest with you. Here's what I do. I have a credit card that I use for all of my business expenses. And so then at the end of the year, I have that credit card annual statement tells me everything that I did for expenses over the course of the year for my business. On that credit card, I only put business expenses. I do not put any personal expenses on there. The reason for that is that credit card has like a $450 annual fee. It's got I think it's a Chase Sapphire Reserve card. And so in using it solely for business, I can then deduct that annual fee as a business expense because it is solely used for business. So those are some things to keep in mind. There are other tools you can use. I think QuickBooks is commonly used in terms of tracking expenses. There's probably some others out there that make sense. Apps that you can use to track mileage, for instance. You just turn it on when you get in the car and drive somewhere for business, and it tracks your mileage via GPS. Plenty of options for this, and little tips and tools and things you can use. I'm just going to pull one more question here from the YouTube, and Trevor asks, how generous are banks with giving loans to professional handicappers? Yeah, getting any kind of bank assistance when you're a professional gambler is tough. Here's the thing, you need to have a business account. If you are transacting large amounts of cash into your personal bank account back and forth, your bank's going to shut you down. They all do it. It doesn't care how big the bank is. Once they see you transacting all this large amounts of cash back and forth, they want nothing to do with you. However, if you have a business, they want everything to do with you because they start to charge you for cash transactions. Any business account, you go over a certain threshold a month. I think mine is $15,000. Anything over that, I get charged per $100. I think I get charged like 10 cents per $100 in terms of cash transactions on my account. So they're fine with me transacting large amounts of cash back and forth in my account. So be it. But in terms of like getting business loans and business lines of credit, I do have a business line of credit that I was able to establish. And once you establish that credit, keep that credit good, then getting a loan down the line won't be so hard. The trouble with being a professional gambler is it's a service industry and you don't have a lot of tangible assets as collateral for anything you do with a bank. You basically just have your brain that you're working with as a professional gambler. Your mileage is definitely going to vary when it comes to dealing with banks as a professional gambler. But if you can establish that relationship and build on that relationship, it goes a long way. Okay, I think that just about does it in terms of our questions here. I hope this was informative to everyone. This, like I said, was a presentation that I did about a year ago, back in February, actually. And so it was something I kind of had queued up already. And so I wanted to put out that Making a Modeler episode 2. And hopefully you've gotten to enjoy that as well. But if you have any other questions, you can reach out to me on Twitter at CapJack2000. If you're watching on YouTube and you liked this presentation, please consider giving me a thumbs up or subscribing. You can subscribe and hit that notification bell, and then you're alerted anytime I go live in the future. You don't have to just see the posts on Twitter. And I appreciate all the feedback, positive feedback that we received. I hope everyone has a good weekend, and I'll see you back here next Friday. Thank you.